the market's pretty divided on the state of the economy, on where inflation is. What are you positioning for? Peak inflation or not?
I think we're still positioning for, one, volatility, and second, maybe even with some respite in inflation, for the Fed to keep going from a normalization perspective. I don't think we are close to that idea of the Fed stopping or pausing here, given the inflation backdrop and the strength of the labor market that we saw last Friday. So I think at this point, you still want to actually position in a cautious way.
What is the risk of a surprise, and how might that play out? I mean, given where we are, given the inversion and twos and the tens already at the deepest level in about 20 years.
So first of all, the inversion of the rates curve, it's hard to compare with the previous inversions. The market technicals are very different. The ownership structure of the market is very different today. And I do think given where the inflation is and the Fed's path is, there's room for more inversion from here. In terms of the surprise, I would expect to see some respite in inflation given the decline in the gasoline prices in the US. But nevertheless, absolute terms, inflation is still going to remain high.
Neeraj, the thing is, the last time twos and tens were this inverted was around about, I think, 2000. The Fed had raised rates to, 6.5%. Expectations were the rates are going up to about 7.75%. But the yield curve then was distorted by what were, I suppose, fundamentally a healthy state for the Fed's finances. Well, the financial position of the Fed now is that very balance sheet is now distorting things too, as indeed possibly is quantitative tightening. So what gives?
So I think overall, if you look across the globe, you have a very different backdrop today. And you do see, in fact, the dispersion from the policymakers' perspective. And the global fixed income markets are a lot more intertwined than 20 years ago. So you still have the Fed, which has to keep moving, reduce balance sheet. And at the same time, you have a Bank of Japan, which hasn't even started to blink. So from a global fixed income perspective, the demand for duration will come back as the rates move higher. So I'm not sure that necessarily you need to see a meaningful sell-off in the rates market in the US because of the Fed hiking. Obviously, the short end of the curve belongs to the Fed, and that will react. But the intermediate to long end of the curve depends on where the demand for the duration is.
So, Neeraj, how does that affect what's going on for credit in this part of the world? Because ultimately, we've also got a bit of resilience taking place, because some of these supply bottlenecks have been eased, and certainly we do see growth at least.
So from a credit market perspective, obviously, it comes down to a combination of the fundamentals, valuations, and the technicals. On the fundamental front, obviously, we've seen China real estate high yield going through significant pressure from a default perspective, whereas rest of the markets have been more range-bound. The technicals have been negative over the last 6 to 12 months, in fact, and you've seen that pressure on the risk premia, and the valuations have started to open up and become attractive. But I don't think we are there to take a very bold call from a long credit risk perspective in this part of the world. You need the overall rates wall to come down and some stability in the US dollar before you actually take a much more strong view on a credit side.
How about in the space of junk bonds? We see China's junk bonds unwinding, but obviously there are opportunities in junk bonds elsewhere in Asia. What's looking attractive to you?
So specifically in the junk bond category, we like India, we like Indonesia, and pockets, again, very much of idiosyncratic stories in the rest of the region. But we do have a bias towards quality, even within the high yield category. I think in the uncertain economic environment, you do want to stick to quality, in my view here.
I'm just wondering as well, right? I mean, Moody's has come out to say it is expecting more global corporate defaults, not just in China, but elsewhere. I mean, how are you factoring that in? How might that play out?
So first of all, defaults they are an integral part of a credit cycle. And as you go towards the turn in the credit cycle, the default rates will go up pretty much everywhere in the world. I think it comes down to a question of what's priced in the market today, whether you're paid for the risk or not. And we've seen the credit risk premium over the last 6 months expanding, giving you more cushion for absorbing those defaults and the recovery rates.
Very quickly, Neeraj, you still got that strong dollar call?
So I think on the dollar front, I would say most of the work is done. I'm still in the category that I think dollar stays bid, but I would not look at much more of a strength from a dollar perspective, given the relative policy expectations, growth expectations are well priced in at this point in the market.